Welcome to episode 3 of the Recap Podcast. I'm Brandon Roth. The conversation today is with Erik Hanson of JLL. He's been selling office buildings in San Francisco for the past 15 years and is part of the top performing team in the market. They sold Transamerica Pyramid Center as well as many other high profile deals. They've also been the most active group over the past 12 months, selling many of the recent transactions. We covered many topics in the conversation, including tenant demand, investor underwriting criteria, the overall state of the market. So if you have any questions after listening to this, please send me an email at brandon@lakebrookcapital.com.
This is the Recap Podcast.
So I think you and I both started in San Francisco around the same time, 2009, 2010.
Yep.
In order to give people context on where San Francisco is today, it would be helpful for them to first understand what the run-up was like from 2010 up until the pandemic, so they can get a sense of where peak values were versus what the reset basis is today. Would you mind just going through that recap?
Yeah, that's a really pertinent point. I think it helps add a lot of perspective as to where we've been and where we were and where we are now. But yeah, I started in brokerage in capital markets in 2009, coming out of a job in consulting. And, in a lot of ways, the market was really similar. There was a tremendous amount of disruption. It was a capital markets derived event. The market froze and the market was sort of upside down. And we saw in 2009, I think there was maybe 2 or 3 sales that year of office buildings, and they ranged from 180 to, I'm going to say, about 225 per square foot, right? So very similar data points to what we've seen a little bit more recently in the market. And, I think everyone thought that there would be this wave of distress as it related to loans and maturities and short sales, et cetera. And, there really wasn't much. There was really only a couple that ended up happening as a result of the GFC, which I think was surprising to a lot of people. And, 2010, 11, things started to pick up a little bit and really things just took off. And I think looking back on it, I didn't really know much at the time. It was up and down, but looking back on it, it was really derived by the leasing market. When you look at what happened in San Francisco, the apps, everything that's just, commonplace today, that was all really new. And you look at some of the companies that started to grow within San Francisco during that period of time. There was some of the big tech names that were out there. Salesforce obviously was around and established, but companies like Airbnb and Uber and Pinterest and all that. I mean, they were basically nothing then. And then over the course of time, ended up being massive users in the San Francisco market, going from a few thousand feet to nearly 1 million feet in some cases. And then we saw, some of the big tech names like Google and Salesforce and Meta that, had a presence in the market or no presence. They all got into the game as well because they wanted to have an outpost in San Francisco to be near their younger employees for recruiting, et cetera. So the point is that the leasing market just completely took off and the capital markets followed once the financial markets sort of stabilized. So what we saw was those trades in the, 200 to 250 a foot in 09, 10. 2 or 3 years later, doubled. So it went to 400 or 500 a foot. A couple of years later, they doubled to the point of, by 2017 through 19, we were seeing buildings trade on average for 800 plus a foot across a variety of profiles. Anything from trophy office towers to historic 100-year-old creative buildings, and we saw probably close to 20 trades north of 1,000 a foot. Some from new construction. Most notably, we saw a few vacant buildings trade for over 1,000 a foot with the thesis that you could buy it vacant, do some work, plug in $100 rent, and that was the market. And it was, the fundamentals in 19 were, roughly 5% vacancy across the entire market, average rents in the low 90s across the entire market. So it was an incredible run up that, obviously when COVID hit, just the party stopped per se.
Right. And then so after COVID, let's just go maybe to the 2020 to 2023 time period. What does that look like for the last 3 years?
Yeah, I mean, obviously the world stopped and no one really knew what was up and down. Obviously 2020 was a year of, a massive sort of freezing, trying to understand what this all meant. No one really knew for anything, but in particular office, whereas hospitality and retail felt the impacts right away. Office did not. People were not coming to the offices, across different regions and all that for, policy or whatever it might be. I think we all knew that this meant something, but it was impossible to know. I think, looking back, we all thought, hey, we're going to go home for a couple weeks. That became a couple months, and then it just changed the entire dynamic. So 2020 was still figuring that out, and we saw quite a few trades in 2020 that were kind of a carryover from pre-COVID times. Some longer lease term or WOLT deals still traded, and there was still a fairly liquid market, and that kind of continued into 21, obviously because the capital markets and debt markets were still incredibly accretive, liquid. Interest rate, the indexes were virtually zero, so you could still sort of engineer deals at that point in time. And as things kind of went on, I think there was more and more realization that the world had changed related to office, right? And whatever the new normal was not going to be the same as it was in 2019. And I think in San Francisco and the Bay Area in specific, it was a lot more severe than other metros or other markets in the country that has continued to today. And obviously, when interest rates started to rise in 2022, that was kind of that was a big event, because you had fundamental issues on the user side and on the demand side that still were unclear and still are unclear, mixed with rapidly rising interest rates. That just really was a really potent mixture for transaction activity. So as 22 carried on and into 23, there was very, very little transactions in the market. I mean, the market effectively froze into the early part of 2023. So very challenging to, understand where we were going to get out of this. And, we that are a little bit more on the front end of transactions knew that it was not good for values. But it takes time. And when there's no data points to point to or what all that and understanding what that looks like, no one really wants to transact. People don't want to be the first to move on the buy side, and people don't want to be the first to move on the sell side. So it creates a really challenging environment. But what we finally saw early last year and really throughout the course of 2023 was that freeze thawed. So we ended up seeing plus or minus 10 transactions last year, about 500 million in total value, which doesn't feel like a lot, but it is related to their overall environment, and that finally helped establish pricing of what are vacant, high vacancy to fully vacant, more value add deals worth now in this new paradigm, and the general consensus that's in the 200 to 300 a foot range, where most of the comps fell last year. So it's painful, a lot of hard conversations, but any market needs that to happen. They need that reset to happen so people can understand where value is. There's comps on the board, and people have to make, the hard business decisions to sell on that side. And then obviously buyers, feel more comfortable that there's a market and that they're not going to be the silly first mover or whatever you might call it. And really we saw a lot more buyers emerge as the year went on, which is encouraging as we sit here today as well.
Right. And when buyers are looking at a vacant building, do you have a sense of how they're underwriting a pro forma looking forward in terms of lease up assumptions and rents? What's going into that analysis when they back into what their purchase price is going to be? Yeah.
I mean, the, institutional way of underwriting of, using Argus and putting in assumptions and solving to a levered return or a levered IRR, et cetera, is really challenging. It has been, it continues to be, because as we know, you can put a million assumptions into your model, and a lot of it is still, educated guesswork at best right now, given the challenges in the leasing market. So ultimately, what we're really seeing is kind of back to the fundamentals, hyper focus, stock pickers mentality related to locations. It's related to specific buildings, and it's really a focus on basis. So it's, can I buy a building for 60, 70% off of what it would have traded for in 2018 or 2019? That feels good. Can I buy a building for 70% off of replacement costs? That feels good. And ultimately the buyers we, have seen with that mentality, especially early on, were, more of the high net worth, family office type of individuals who could look at a business plan for a 10 plus year hold. So that was their base case. And if things, roar back tremendously, they could make a decision of selling early or putting, refinancing or putting debt on it, because these things are all cash. But it's really just a focus on sort of the basic fundamentals and inherent value in real estate, and a belief that San Francisco is going to come out of this better, obviously, than it is today.
Right. And can we pull up that aerial and go through some of the specifics on what's been happening over the last couple of years? I can pull it up. 1 second. Hopefully we're able to see this. Can you see that screen?
I can see it. I sure can.
I think what would be helpful to understand is maybe just, how this has evolved, because we did talk about how it started to unthaw in early 2023. And I think you can see that example where it appears the first trade is Sobrato buying 1 Harrison, right? Because that was February. And then how the market evolved from there over the course of the year.
Yeah, and it's interesting because that was sort of the first one to hit, and that one is pretty unique. They purchased that from Gap Corporation, so corporate seller, which was definitely a theme of some of the first trades or properties that came to market. It's right on the Embarcadero waterfront. It's a very unique, special piece of property. So the price per square foot on that was certainly higher than you're going to see on a lot of these other comps, but it's probably one of the more unique buildings and locations in the city. So the metrics on that were a little different. And then some of the other ones that received a lot of press or publications were 550 California Street that Wells Fargo brought to market, and 350 California Street that Union Bank also brought to market. And those were corporate sales, predominantly vacant, former sort of corporate HQ type buildings that needed some amount of work. And the business plans, kind of differ amongst all of these comps, which is kind of fascinating in its own right. And then I think another one that got a lot of sort of notoriety was 60 Spear, which we were involved with, which was actually an institutional seller that decided to sell down out of some of their portfolio of office. And that one, again, it's a really kind of unique location down on Spear Street. The building has water views, et cetera. And that was for us sort of, what we kind of think is sort of the bottom, in that people really realize that, hey, this is a building that's, again, significantly discounted off of what it would have traded for pre-COVID. They liked the real estate, they liked the location. And for us, we saw over 10 bids on it initially. We had a, competitive process and ended up selling to a group that has, a longer term view on the market. And in this case, are going to spend a significant amount of capital upgrading the building and really trying to turn it into sort of a boutique trophy asset and lead into the higher end of the market, where we've seen a lot of data on the leasing front that seems to support that if you build something unique and special, you will be able to lease it and sort of outperform the market. So there's a wide variety of trades, business plans, et cetera, which is all sort of fascinating. But once all those started to hit, I think everyone sort of woke up, kind of across the country of, hey, San Francisco kind of feels like it's on sale. And if we can get in on this now, that'll be an interesting bet to make. And to some extent, that sort of FOMO mentality said it as well, is that they didn't want to miss this opportunity to make a bet in a market that's always showed ability to bounce back, significantly after these hiccups, whether it's .com or GFC and now the pandemic.
Right. And when you look at a deal like 350 Cal that SKS and Swig purchased for just over $200 per square foot, do you have a sense of what they're looking to as their all-in basis once the property is renovated? Is there a certain dollar amount in mind? I'm just wondering, are these guys getting to $400 a square foot all in, for example?
Yeah, I mean, in general, our understanding of their business plan is to try to control their costs as much as possible, and to really play the basis game, if you will, is to not spend $150, $200 a square foot on TIs throughout the building or a massive base building upgrade, but to maintain their basis as low as they can to do deals and leasing deals at lower numbers, obviously, than sort of the pre-pandemic rents or whatever that they could have gotten there. So, but again, they have flexibility. The Swig family has been investing in San Francisco for over 50 years at least. So they have a very long-term approach. So the assets that they're involved with, they've owned for a very long time. And I think that kind of, plays to the point is, hey, base case, we're going to try to do leasing, fill up the building as much as we can, get it to 70, 80% leased over the next 5 years. And that's great. But if there's an opportunity for them to meet a market and spend a little bit more money to push rents, I think they'll consider that as well. But I think that flexibility and not being sort of backed into a 5-year business plan or whatnot is ultimately what gave them confidence that, hey, if I could buy a building right in the middle of California street in the financial district, a high rise that's, overall in good condition, has had a lot of base building work done to it for this price. That feels good. It feels hard to go wrong there. So I think they're excited about it. And they've actually done a little bit of leasing there out of the gates as well, which, I think kind of plays into their business plan initially.
Yeah, I think that's a really interesting example of somebody who purchased a building at a new reset basis and they're able to sign leases right away. So if rents were $90 per square foot before the pandemic, where do you think rents are today for leases that are getting done?
Yeah, that's a great question. And it's something that we're talking to our clients a lot about is it was kind of an anomaly when you look back on it now, where effectively average rents across San Francisco were low 90s. And that would be, Class A towers right in the middle of downtown with views. And that would be lower rise buildings in the western part of Soma or mid-market. So in a way, that didn't really make sense. Like when you compare it to Manhattan, for example, there's parts of Manhattan pre-COVID that would lease for $40, $50 a square foot. And then there's parts of Manhattan that would lease for $200 a foot. There was very, very different segmentation within that market. And San Francisco didn't really have that just because our vacancy is 5%, it's a smaller market, et cetera. So what that means for today is I think we're going to see a much wider band of rents. For example, the top 10, even 20 buildings in the market with water views, amenities, great locations are still getting, pre-COVID, if not higher than COVID rents in some cases, which really, again, plays out to what I mentioned earlier, the sort of flight to quality, best assets thesis, if you will. And then the really, average to low tier buildings, whether it's, the building quality or location, or the rents are dropping significantly. We've heard comps in the, 40s, 50s, et cetera. So I think that's where it gets to the different business plans and thesis of, in the case of 350 Cal, I think they would be fine signing $50, $60 leases, which are, a discount of where they were, but it makes sense given their basis and it works for their business plan. In the case of 60 Spear, they're going to spend a ton of money to stabilize the property to make it extremely unique and just go absolutely bonkers on amenities. And they're going to obviously need and drive to, higher rents to make that business plan work. People can argue about what's a better thesis or business plan, and I'm not going to take a position there, but it will be interesting to look out 2-3 years down the road to see what's working and what's not. I hope they both work for the sake of the market, but I think you're going to see much more of sort of a stratification in terms of rents, business plans, et cetera, go up for.
Yeah, no, I think that makes sense. And it feels like there are, two different strategies here. There are vacant buildings or mostly vacant buildings that are being sold in the low 200s per square foot or maybe 300 per square foot. But then if you look at other deals where there is a tenant in place paying a decent rent, like 123 Townsend that Rubicon purchased, and that's 533 per square foot.
Yeah.
Can you just touch on maybe the difference between those two different investment strategies and what people are focused on when they're buying a deal that has a tenant in place and what they're paying attention to and what cash flow metrics they're looking for?
Yeah, I mean, in that case, you did have an anchor tenant that had, just over 6 years, I believe, of term left. So it's a pretty good duration with that cash flow left with some credit behind them. And ultimately, it's balancing out, what's a fair, cap rate to play or to pay for that asset. What's your mark to market cap rate? So it's analyzing the in-place rent versus what they believe rent is today. It used to be that, your mark to market was up. Now it's, in most cases down. And then it's obviously sort of saying, does this price per square foot make sense? And in that case, they did receive seller financing from the seller, which really helped facilitate that transaction. And ultimately, we've seen some examples of that with cash flowing assets. Sellers are offering that as a way to create liquidity and to sell down assets, part of their overall strategy. And then buyers look at it as, hey, if I can sort of get favorable financing with cash flow, I can sort of engineer a cash on cash return that's kind of interesting. So when you look at the price per square foot, for example, the amount of cash flow they'll be able to pull out of it during the term of that lease, kind of, we call it buying their basis down. So by the time the lease matures, their sort of financial basis or engineered basis will be much lower than that, acquisition basis. So it's just different strategies, we're seeing, and I think it's interesting, right? Because we're seeing a lot of creativity, both from sellers and buyers to try to make transactions happen, get them done. And it's encouraging to see again in 23 now going into this year that, people are looking for ways to do deals, not ways for not to do deals. And again, that's a sign of a healthier market where you see sellers, capitulating, trying to be creative, and then buyers obviously trying to find ways to make a bet. And that's what we've been waiting and wanting to see in the market.
Right. And I'm noticing here that you sold 600 Townsend East in September, and you just awarded 600 Townsend West recently. Any change maybe over those 5 months from the market, given how many other deals had traded in between and what the market appetite has been? And it feels like it's sort of evolving over the last few months.
Yeah, I would say once that first wave of transactions closed in the early to middle part of 2023, I feel like sort of the bell rang or the alarm went off of people said, oh, wow, San Francisco, there's deals happening. And we really saw a big change, particularly from buyers. Our bid sheet started to fill out, as I mentioned, was 60 Spear, over 10 bids. 12 months before that, we would have been shocked to get over 12 or 10 bids on a deal. So we just saw a lot more buyers come into the market. And that was, as I mentioned earlier, it was really a lot of high net worths, which there still are in the market, but we saw more local operators, institutions, even foreign capital in some cases come into the market, which was really surprising to see, I guess, this early on in sort of the next phase of the cycle. But there was just an overall change in sentiment. So, those two buildings are right next to each other, sort of different situations and profiles, but that was the main theme is just sort of this change in sentiment of instead of the falling knife, I think people felt that a bottom had been formed, and that's where you need to start. And, we anticipate that to continue as we move forward into 24.
Right. And I agree. I think you will continue to see that change. I think, there are a lot of groups now that are aware of a San Francisco office basis play, and they see that the market's already bottomed out and it's starting to come back up in terms of what the new prices per square foot are for the most recent transaction. So I definitely believe it's picking up momentum. On that front, what are you seeing from a tenant demand perspective? There's a lot of talk about AI tenants, for example. Is that currently driving the market in terms of new leasing, or is it going beyond AI companies?
Yeah, I mean, I think that gets into the thesis of San Francisco, and what people are, excited about and buying into is that, AI is definitely the buzzword right now for sure when it comes to the tenant market. And, our answer is it's exciting. We're lucky to have what people view as sort of the next evolution or wave of technology, which is AI, effectively based in San Francisco with sort of the household names headquartered in the market. Everyone saw the news with OpenAI and Anthropic and such taking big pieces of space last year, and over 1 million feet, I think, of total leasing, which is great news for the market. On the other hand, we have mid 30% vacancy in the market. So, close to 30 million feet. So 1 million feet's not going to do it, but to have that in the market is absolutely a positive. But it's going to take sort of all fronts for the market to sort of stabilize and return to a healthy nature. So it's going to take big tech getting through their sort of space rationalization, which we think is happening, is pretty close to sort of being done with in the near term. But big tech, the companies I mentioned that have always have grown significantly in the market, need to continue to be a big player in the market going forward. And we think that generally that'll be the case, that there still is a case to be in San Francisco. And, yeah, it's interesting. I mean, 1 million feet last year, we definitely have tenants in the market today. It's not quite, the demand. I don't think we're expecting 1 million feet to be leased in the next couple months, but it's rapidly evolving, and their space needs are evolving. And there's a lot of discussion about how, again, if you're a company trying to grow, just like it's always been, that, building and growing a company, it's hard to do that if you're not all in the office together, working, collaborating, et cetera. So, we're encouraged by what we're seeing. There's a lot of work to be done. We're not there yet, but San Francisco, once again, seems to be the place where the next, evolution of technology and change is sort of based. And, that's what people look at as, we've seen this happen before. There's a belief that it could happen again.
And you mentioned 30 million square feet is vacant, but with your earlier comments about the flight to quality and, record high rents and trophy buildings, I would assume that vacancy is more concentrated in Class B and C buildings and less so in Class A. Is that fair?
Yeah. At JLL, we've done a tremendous amount of studies, both within our capital markets group, specific to office and research, et cetera, working with our leasing teams and all that to really, understand what we believe the market's going to look like, today and going forward. And I think to my point earlier is it's just, you really have to dissect and study the market in a very, very specific and focused way at this point in time. The data we have on hand shows that, the top buildings in the market, we kind of track the top 20 based on location, views, et cetera. They've hovered around 10% vacancy through COVID. That's strong. And a lot of them, are achieving rents par or above where they were pre-COVID, which is also, that's amazing data to really, absorb and understand. And we also look at parts of the market, sub-markets that are just more challenged, that benefited from sort of the upswing in the market pre-COVID that, we think are going to be, they're going to take much longer to recover, going to take much longer to see positive absorption. And, quite frankly, some of those submarkets and buildings we view as sort of separate them from the overall market for a period of time. So, we call the San Francisco market roughly 90 million feet. But if you start to, sort of dissect it and take some of those out, the market's going to get a lot smaller in the near term. So it's really just about studying these things in a really thoughtful way to see how, certain buildings, submarkets, streets, blocks are going to perform. And I think that'll be the theme in the near future. It's not a momentum market. It's still very much a market of trying to, make a smart bet based on a lot of the data that we have on hand.
And I was talking to an investor that's located in New York, but looking at office deals across the country. And one comment that they had was that they're currently seeing a lot of activity in the 5 to 10,000 square foot space for tenants, and also noting that when they look at co-working spaces, that they're all completely full. So showing that there's demand for maybe these smaller companies that need less space than some of the big tech companies. In San Francisco, are you guys seeing something similar about with the 5 to 10,000 square foot range?
Yeah, that is a theme that we're hearing more and more of from our leasing partners and colleagues is there is a lot of growth from these companies that, they might be starting a business that they were all remote and they now know that they need to gather and they don't want to make a massive bet. Again, pre-COVID, you saw a lot of situations where a company might only need 5,000 feet, but there were no options. So they're being forced to take 10 or 20 to accommodate future growth. So no one's really doing that right now. Everyone's being extremely thoughtful about their capital spend, and it's derived from the VC markets and everything going on in the greater, economic and capital markets. So everyone's just being very thoughtful and smart about how they're spending their money, and not making decisions on a pure speculation. So we are seeing a lot of growth in that market. And I think it's important to remember, specific to San Francisco, that historically speaking, San Francisco has always really been a 5 to 10,000, maybe 5 to 15,000 tenant market. It was really, the strength of the market historically was the financial services industries and, the FIRE tenants. So that's always been kind of the core of our market. And then it really became a big tech town in the last 10 years leading into the pandemic. So to see that is, it's encouraging and sort of, I think, aligns with, San Francisco, how it's historically performed. But again, we are seeing some of the bigger requirements out there. Again, to see OpenAI take a 400,000 plus, sublease last year. That's big. There was a lot of that happening. It kind of became commonplace in the market pre-pandemic to see, 3, 5, 700,000 foot leases, but that was sort of more of the anomaly. So we're seeing it on both sides. And again, that's sort of what creates a healthier tenant demand market out there.
And there was an article this morning about Deutsche Bank requiring their managing directors to be in the office 4 days a week instead of 3 days a week. So are you guys seeing anything from a work from home perspective in terms of changing trends about people coming back to the office in the city?
Yeah, obviously we at JLL, it feels like everyone related in our business and our industry has followed that extremely closely over the last few years because it's, a very important indicator of what, office demand and future requirements will look like. But it seems to be a theme we're seeing more and more of as time goes by, as sort of this, post-COVID world environment. People, there was no recipe for how to do it. Everyone was trying to figure it out as they went based on their, company culture, policy, where their employees lived, how they got, were they commuting to work, and everyone. So yeah, everyone's been trying to figure it out. But it does seem that there is more of a, momentum to say, look, to have a strong business, to maintain a business, to build a business, we have to have in-person collaboration. And I think in a lot of the cases is if you're a leader at a company or a manager and you're asking your employees or those that work, for or with you to come in 3-4 days a week, but you aren't, that's not leadership. That's not setting a good example. So I think we're seeing more of that as well, is that you have to put your money where your mouth is or whatever it might be. So it's not going to all happen at once. I think everyone now is, there's no more expectations that, post Labor Day or whatever it might be, some dates that, the things are going to change on the snap of a finger, but we are continuing to see more of that happening, which I think gives people confidence that sort of the return to the mean that we've all been waiting for a little bit as well is sort of, it's happening over time, but it's taking a while. It's not going to happen overnight. It takes time for that stuff to sort of re-rationalize or re-normalize that no one's really been through something like this before.
And my sense of it was that given how tech concentrated San Francisco was from a tenant base, and the tech industry being the ones that are slower to return to office and are more friendly towards remote work, that it just makes it more challenging for San Francisco specifically in terms of bringing people back into the city and increasing occupancy compared to other markets. Like if you look across Texas, for example, where there's other more diverse, employment base, and it's not so tech concentrated, those markets seem to be more occupied at the moment.
Yeah, no, that's right. San Francisco, as I mentioned earlier, was, historically speaking, more of a finance hub, law, et cetera. Those types of tenants are the ones that have, been coming back to the office and continued to go back to the office, where a lot of the technology companies, their policies were much different. That, to some extent, some of them saw some benefit in a distributed or remote workforce. And there's a lot of reasons why, whether it's related to their actual core business or for recruiting. When the job market was extremely tight a couple of years ago, employees would, say, I'll take a job, but the conditions are I have to be able to work from anywhere. And if you didn't have any other options in your recruiting, they would say, okay, because they would have to hire someone. So there was just a lot of reasons why. But I think a lot of the technology companies in specific had motivations or ability to be much more distributed or remote that they leaned into. And we've seen change in that, driven a lot by big tech. And again, I think it's just, from a business case, I think most people would agree that, having people in the office at some point, whether it's 2 days, 3 days, whatever it might be, is good for the business. It's good for culture. Those who want to, the younger workforce, those who want ability to learn and be mentored and FaceTime, et cetera. I mean, can't do that remote. So again, I don't try to take too stringent of a stance on it, because I don't want to get yelled at by this person or that person. But I think there's some ways of thinking about it that again, that sort of rationalization or sort of return to the mean is sort of feels like where we're headed in general.
No, I agree with you. And within San Francisco, are you finding certain submarkets to be outperforming others in a meaningful way?
Yeah, what we're seeing is the core CBD seems to be benefiting the most. So it's North Financial District, South Financial District, sort of surrounding Market Street. That's where, while public transit use is still down significantly, we're like to Barton, Muni, et cetera. That's where they're centered around, having that access is important. That's where, even though a lot of our retail amenities have been suffering a bit post-pandemic, that's where a lot of the amenities and, bars, restaurants, et cetera are. So we've seen better performance there. And when you go into downtown San Francisco, and I could be the first to tell you that it feels a lot better than most people think. That's where a lot of the activity, foot traffic is as well. And one other submarket that continues to, get a lot of headlines is Jackson Square, which is a smaller boutique submarket kind of right outside of the North Financial District. And I think when you go to a submarket like that, it's got, really nice character. It's kind of the old Barbary Coast, some really interesting buildings. We've seen a lot of VC firms open up offices there, some tech firms. It's always been sort of a media advertising submarket. So you just have a lot of different tenants. You've seen a lot more retail there. It's closer to the northern part of town where a lot of people live or Marin. So it just made sense. And it's a very small submarket. So inherently, any kind of, outsized demand is going to make the fundamentals in that submarket much stronger.
I asked a few people on LinkedIn if they had any questions for you. I'm going to throw some at you. We'll see how this goes. And obviously this is, a ridiculous question, but I'm sure you get it all the time when people are asking you, is the office market dead? Is it coming back? But I mean, I think you and I both know that it is, but since you probably have to repeat that so many times, how are you portraying that to people?
No, I mean, we have gotten that question, and you could read a million articles now about people pontificating about the future of office, whether it's dead or not, and there's so many factors that go into it. But the data is what we try to focus on. Right? Is you can speculate, you can say, oh, it's dead, or it's not, but the data is what's important, which we've hit on, is that there's absolutely evidence that certain buildings, flight to quality, et cetera, are absolutely performing well and benefiting. So that part of the market, albeit much smaller, is very much healthy and alive. Then you get into just the overall demand side and space usage side that, again, it's just taking longer to rationalize and understand what it looks like, but all the trends seem to be pointing to that, going in a positive direction as it relates to office. And I think it's just really important as I mentioned, JLL, we have a lot of different studies of tiering buildings and subsets of, looking at performance going forward. And I think if someone made me answer the question right now, is that you're going to see effectively office markets, not only in San Francisco, but across the country, shrink for, overall stock shrink for the near term and maybe for the long term, right? Is that if there's 10 or 15 million feet of sort of B, C product that was never really great to begin with, that owners are not going to put any money into, those could sit vacant and fallow for many, many years to come. And whether it's, there's a lot of talk about conversions or whatnot, I mean, that'll be a little bit part of the game, but I do think that there will be a shrinking in the office market. There's going to be a flight to quality, but it's not dead. And then that's what the data suggests right now. And my answer in a year's time could be different, but I feel pretty confident saying that right now about, certain segments of the market.
No, I think that's a great answer. And if somebody asked, for buildings that are multi-tenant office buildings and mostly occupied at higher rents that are, pre-pandemic rent levels, and new rents are getting signed at probably 50% of those levels, so your NOI is going to be declining as tenants are rolling. How are investors thinking about that when they're calculating their purchase price? Are they focused on some kind of return as their NOI is going to be declining over the coming years?
Yeah, and it's going to be different, right? In every situation, to the previous point, is some of them might have pre-pandemic rents, and if it's a trophy building, they might be keeping rent the same or maybe even increasing rent. But I understand the question. It's the going in cap rate is a question we always get when appraisers calls, whatever it is, and it's always a really tough metric as it relates to office. And I don't want to say it's irrelevant, but it's never the perfect indicator of value, because there's so many factors that go into it, except for a long-term single tenant deal. But they're looking at going in cap rate, especially right now, is do you have a nice significant yield in the near term? And then they look at the roll when leases are rolling, the WALT, or the weighted average lease term, and they're looking at what the mark-to-market rents are. So it's really a return on cost metric. So it's either a 3 or 5 year metric of saying, whatever the cap rate is I buy it today, what am I going to stabilize this building at? And it's your purchase price plus all the costs to stabilize, which is TIs, base building work, commissions. And they're looking for that metric, which is an unlevered metric, which is really important. Pre-pandemic, the underwriting was a year 3 return on cost in the 6 to 6.5 range. Today, it's much higher. It's closer to 10%. That's a point in time where you have so many factors that we've discussed that's driving, lower values, much more conservative underwriting. I think that'll come in as things progress, but obviously that's a very elevated metric. But that's a key thing that people look to, because it, I think, really helps evaluate risk of their business plan going forward. And obviously, when you plug all that into their model, it ends up, spitting out the price per square foot that we're talking about today. So that's kind of the general way of thinking about it.
And when new tenants are looking at signing a lease, given how much lower rents are today than they were a few years ago, are they signing long-term leases to lock it in for 10 years, or are they doing shorter-term leases?
Yeah, it's a good question. It's obviously a tenant's market. The tenant rep brokers and stuff are educated on the market, and they know that they have a lot of leverage and a lot of power in these discussions. So, I was on a panel last week with a tenant rep broker that said, they're basically asking for everything and seeing what the landlords agree to. but there's no common theme related to term. I think in today's world, we're still seeing, more of a desire to have flexibility, which is, we want to sign a shorter term lease because we just don't really know what our space needs might be in the future. I think when you go back to the GFC, we did see quite a few examples of people locking in 10-year deals because they knew the market was depressed and they wanted to take advantage, and they had a pretty clear line of sight of what their space demand would be. People don't have as much of that clarity today. There's been a general thought that people are decreasing their space needs by 10 to 20%, but that's today, and given everything we're discussing, that could be different in a year. So I think that sort of near-term flexibility seems to be more of what I'm hearing out there in the market right now.
And then final question here. If a building with a steady credit-worthy income stream went to market, what cap rate would it clear at? So we're trying to find out what's the valuation for stabilized buildings versus these value-add deals.
Yeah. And again, variety of factors. It's length of the lease term. It's the tenant, and are they investment grade credit or are they, startup back credit? I mean, all that is extremely important. My answer to you is, not only regionally, but nationally, given, and again, it all really triangulates off of where interest rates are and where the cost of debt is. Generally speaking, it fluctuates based on even this week. I mean, everything blew out a little bit on the index side, but what we're hearing is sort of best to the best debt for something like that would be in the mid 6 range generally. So the cap rate, generally speaking, needs to be spread above that. So if it's something that's really, really desirable, bulletproof, it might be 25, 50 basis points, so high 6 to 7, but probably more in the low 7s. But my answer today was different 2 weeks ago, and it'll probably be different now. But we're in an elevated environment. Going back to what I mentioned back in 2021, where interest rates were so low, we were seeing core product with single tenant core product trade in some cases, mid to high 4s, low 5s. So, and again, that's just an example of what the increase in interest rates has done to the single tenant cap rate there. But it's a point in time. Hopefully, it'll get better going forward.
Right. And for the sales that we talked about that have traded over the last year and a half, are any of those getting financed, or are they mostly being purchased all cash?
The vast majority are all cash right now, because when you're looking at a value add, predominantly vacant building, pretty much the only source of capital is through a debt fund, which is, SOFR plus 500 to 600. So you're talking about 10 to 11% money, dependent on where the index is at that point in time. So that's extremely expensive. And why that's so punitive is if you're buying a vacant building, you can buy it for $200 a foot. Hey, that feels great. But if you have to feed that debt for 2 years at 11%, that starts to eat into your basis right away. And that's you kind of on the clock day one. And that's just, given all the things we've talked about, the risk factors and making that bet, to also have this really expensive debt that you're worried about is just too much. So most of those have been financed all cash, or have been done with all cash and no financing. There have been a couple of examples of some debt that has been incurred. For example, 180 Howard, they did get a loan on that. And mainly is because there was a partial lease back from the seller on that effectively covered the debt service on that for the near term. So those are the situations that I mentioned on 123 Townsend. That was the seller financing, but we've seen, pretty much, 80 to 90% of the deals are all cash, and they will be for the foreseeable future in most cases until there's a more, liquid, accretive debt market for office out there.
That's great. Thank you, Eric. Really appreciate you taking the time to do all of this.
Yeah. Good to see you, man.
Yeah, likewise.